Good morning. And on behalf of the Council and the Secretariat, I'd like to thank you for joining us for the launch of the Council's June 2024 Fiscal Assessment Report. As you all know, we're an independent body established under the Fiscal Responsibility Act 2012, and our mandate revolves around four elements: endorsing and assessing the official macro forecasts, assessing official budgetary projections, monitoring compliance with fiscal rules, and assessing the government's overall stance. Our focus is on the broader fiscal perspective rather than individual tax or spending measures. And in our latest June 2024 Fiscal Assessment Report, we assess the government's medium-term plans as set out in April's Stability Programme update. Okay, so I'm going to talk through the sort of key messages of the report. We've sent around the press release as well, but I guess the summary is that the Irish economy is performing well and is operating at or above potential. And as a result, this is not the time for loose budgetary policy. Choices need to be made. Doing everything now, tax cuts, current spending increases, ramping up capital spending, could all overheat the economy and add to price pressures. By not making these choices, the government is planning on breaching the national spending rule this year and next year. It's a net spending rule. That means that any government has the option of raising taxes to facilitate higher spending growth if that is their priority. Another key message is that significant health overruns are developing already this year. And sadly, this is unsurprising given overruns from last year were not incorporated into the budget for 2024. On a more positive note, we welcome, as we did before, the Future Ireland Fund. It's an important tool to manage windfall corporation tax receipts. But if larger savings were made now, that would mean more of future costs of an aging population and climate change could be offset. Overall, the message is the government needs to show restraint to keep the economy and public finances on track. So let me get into some of the more specifics on that summary. And expand on some of the points. So some of these I'll have mentioned already. One thing that may stand out to you is that our assessment of the government's breach of the national spending rule is larger than that shown in SPU 2024. I'll go into some detail about why that is. But we also point out again that government revenue is highly concentrated and could reverse suddenly. Importantly, this does not mean we think it is about to reverse. Rather, the risk is there. And so a prudent approach is to not build spending commitments off this revenue. And because our income tax is also concentrated and likely correlated with the performance of sectors paying the most corporation tax, the impact of a sectoral, or in some cases firm-specific slowdown, the impact on Ireland's public finances could be very damaging. Therefore, the Council believes the current budgetary policy is not conducive to prudent economic and budgetary management. In terms of the fiscal framework, the newly adopted EU rules will bring a welcome medium-term focus to budgeting. But as they're based off GDP, these rules will not be a good guide to Ireland's position. And therefore, the onus is on ensuring a strong domestic framework. As I said, the establishment of the Future Ireland Fund is welcome, but this should not be viewed as a substitute for complying with the national spending rule. In terms of the economic outlook, as I said, the Irish economy remains strong. The jobs market, as shown on this slide, is extremely tight with unemployment rates at record lows, employment at record highs, and participation at historically high levels. Domestic inflation is thankfully starting to come down, but this is driven largely by falling energy prices. Measures of domestically generated inflation, that is, measures of inflation that focus on those goods and services with a very low import content, think particularly cafes, restaurants, and hotels, these remain elevated. And therefore, with the economy operating at or above potential, as shown in this chart, fiscal policy should not add to demand. Loose budgetary policy would add to price pressures and could overheat the economy. Now, there are, of course, well-known challenges. Ireland's infrastructure has become stretched due to the growing economy, and given likely infrastructure shortfalls, it is tempting to increase public capital spending. But given the tight labour market, getting value for money on public investment could be challenging, and I'm going to come back to this point a little bit later. In terms of the budgetary outlook, again, given the strong economy, the key message is that budgetary policy should not add to demand. The government expects the underlying budget balance, this is the budget balance when we exclude the estimates of excess corporation tax receipt, to remain in deficit out to 2026. This would mean 19 consecutive years of deficits on that basis. And again, there are several methodological issues. The one I'll come back to more, but you can already see in this chart, is the issue of health spending overruns not being incorporated in the previous budget and building quickly already in the first half of 2024. In terms of the forecast horizon, the horizon for the budgetary forecast is only 3 years. A much better, much more prudent policy involves multi-annual budgeting with a longer horizon. The current short horizon means that major challenges, relatively imminent major challenges, such as the costs of transition for climate change and the beginning growing costs of an aging population, are not captured in these budget forecast numbers. And then finally, on this, the forecasting on the general government side remains pretty poor. The focus is on the exchequer. General government, taking into account local government and non-commercial semi-state bodies, gives a fuller, more complete picture of the fiscal position. I said I'd come back to health overruns. These have, of course, been a lot in the discussion of late. We pointed out that they were not properly reflected from last year's overruns, were not properly reflected in the budgetary forecasts. And these overruns are now occurring earlier and at a higher level than in past years, as you see on this chart. By our estimates, overruns this year look to run to around the level of 1.6 billion. Now, of course, we're only part of the way through the year, but if you look at this chart, you can see that in previous years, the big ramp ups in overruns came towards the end of the year, particularly as we entered the winter months. So this is not a particularly healthy picture for the health forecasts. We welcome that the SPU spending forecasts actually include 4.5 billion spending, mainly reflecting COVID-19 health spending and humanitarian assistance for refugees. In the budget 2024, this spending was assumed to quickly drop to zero, which of course made the overall position of the government look much healthier. But we still argue that this spending is likely to be longer lasting than a very temporary measure. As a result, it should be included in core spending. And we still see problems with the continued use of reclassifying things or including as non-core core things. This fiscal gimmickry is undesirable. It weakens transparency. Now, as an aside, I want to just clarify the use of the term, which when we used it last time, seems to have excited some people. As we say here, it's a technical term. It referred to the use of accounting techniques to make a government's fiscal numbers either adhere to rules or just look more favorable than they actually are. If you sort of go on Google Scholar, you can find sort of around 2,000 articles written on this. But the key thing is that what this practice does is it means that you either have a better position in a technical, but not an underlying sense. And what we really want to be judging and transparently judging and assessing is the true underlying picture. And again, I'm going to come back and point out where this matters in a couple of slides' time. Standstill costs, we calculate the costs of maintaining current spending into the future, but accounting for things like the changes in demographics or projected cost increases associated with wage and price increases that we expect to come over the years. And these costs are significant. If we look over the 2025 to 2027, 3 years of the government SPU projections, we see that our estimates of standstill exceed the government's core current spending increases as set out in those projections. And these spending pressures don't abate much further out. So there are, just to stay where we are, there are significant growth in spending that is required. The point which we have made, I've been on the council now 5 years, and this point has come up almost consistently across those 5 years. Government revenue is highly concentrated and hence could reverse suddenly. We've estimated on the corporate tax side that they're concentrated, as we know, among a small number of large foreign-owned multinationals. You see this on the chart on the side here, on the left side. And we estimate that just 3 firms accounted for 43% of corporate tax revenues in 2022. But a point that we're adding to this, and others have made this point as well, is that income tax is also highly concentrated. A small proportion of highly paid employees pay much of our income tax. So sort of one, you can see the chart here, but around 20% of earners pay about 80% of the total income tax. And given that some of those high earners are concentrated in those sectors which also pay the high corporate tax, a downturn in a small number of sectors would impact income tax as well as corporation tax. That would be a major fiscal challenge for Ireland. In terms of infrastructure, as I alluded to earlier, there are difficult challenges. As a share of GNI star, capital spending is now lower than had been projected in the NDP, and projects tend to be delayed. But as I referred to earlier, getting value for money when the labour market is tight and some material costs remain elevated is extremely difficult. Fixing infrastructure deficits is a slow process that takes place over many years. It is really important that plans are in place and the government adjusts these plans to maximise value for money, while also appropriately supporting the domestic economy at different points in the cycle, while trying to address the evident infrastructure gaps. Let me just be very clear on what it means to appropriately support the domestic economy. If the domestic economy is in a weaker position and there is lower demand for construction, this is an optimal time for the government to fill that gap and to try to implement as many of the National Development Plan projects as possible. At moments where the domestic economy is extremely tight, projects that can have a lower resource use of domestic resources are to be prioritized. It's a very difficult job. We acknowledge that. In terms of the national spending rule, this is, as we see it, our first line of defense, given that the newly adopted EU rules will be a poor guide for the Irish fiscal position, given they're couched in terms of GDP. As a net spending rule, as I've already said, tax increases allow a government to spend more than the 5% limit, if that is their priority. So, as I alluded to, we estimate the government is set to repeatedly breach this net national spending rule. It's set to increase by more than 5% this year and next year. And since the rule was introduced in 2021, up to the end of 2024, the breaches add up to 8.5 billion or 9.7%. Now, so let me be very clear. I'm going to explain this chart because this is an important, I think, chart. As you can see, there are the 5% path is the dashed line at the bottom. Total spending is if you don't do any distinction between core and non-core. And you can see this really makes a difference in the early years of the rule, where non-core spending, which at the time we think is sensibly non-core, include genuine one-off spending on things related to COVID. As we go forward and some of these spendings become more permanent, we include them as in our estimate of core, whereas the government continues to exclude them. That is the difference between the light turquoise line and the darker line, which is the government's estimate. as you can see, the government's own estimates do not have them fully adhering with the 5% path from 2021. But you can see if you treat core in the way we think is sensible by including these clearly longer lasting spending as part of core, you can see that the breaches are higher. And this 8.5 billion is read off this our estimate of core spending in 2024. And you can see that over the forecast horizon, this gap does not close back towards the 5% path. Okay. Let me say that another way in terms of that was in terms of levels. So let's present it in terms of growth. And I want to just show you the importance of including or not the health overruns for 2024. This is the growth, the 5% growth limit for each of the years. And if you exclude the health overruns that we estimate, then you can see that the government, as we said, violates the national spending rule in 2024 and 2025. But the extent of the violation is much larger once you include the health overruns. And given we have had such a consistent pattern of health overruns, and some of these health overruns were forecastable based on the 2023 numbers, we think our estimate of a much larger violation is the correct one. Okay, so why do we why do we stress this point? Well, we think that current budgetary policy is not appropriate for the economy or the public finances. Our argument, as we made clear both at the budget and even a bit before that in the pre-budget statement last year, is that given the strength of the economy, choices need to be made. This is not a time for the everything now approach of cutting taxes, increasing current and capital spending, and doing this all at once. Again, carefully planned and targeted increases in capital spending can, of course, be facilitated. Supports for particular parts of the economy or particular sets of households can also be accommodated, but this can be done without overheating the economy by either increasing taxes or containing other current spending and targeting the spending in the most effective way. As we've welcomed and called for a long time, the setting up of the Future Ireland Fund is something that we really think is a good move, but we do think that the government could be more ambitious. For 2025, this chart shows that just over half of the windfall is being saved. This would, if they were to put even more into this fund, then there would be larger fund in the future available to offset the costs of an aging population and climate change. These are two imminent costs that we know are coming down the road. And finally, let me just say, we've emphasized the importance of the domestic framework as the first line of defense. And we continue to believe that tying net spending to a sustainable growth rate is a desirable approach. The national spending rule should, in our view, be legislated for. And if it was, then it would be more likely to be adhered to, as we've shown it has not so far. And also to expand it to cover general government. Again, you can adjust for cyclical unemployment, and to ensure that the forecasts take the medium-run horizon. As we said, we welcome that the new EU rules will enforce a more medium-run focus. And again, we still await more transparent costings for climate action and sláinte care. But let me leave it there. The sort of key messages on these slides are the same as I had on the first slide, and I'm sure Niall will make these slides available to everyone after the call.